Okay, well, we get it started. So we will do our presentation and then we will have the opportunity to answer any questions via our Q&A button, which is in the tool panel of Zoom. So hopefully if everyone has some interesting questions, we have a chance to put our insights to use and maybe give some key tips to people. So let us start with our webinar for today, where we will be talking about, probably if we put the top hot topics of 2023 is inflation. And I guess the reason we put this webinar together is because an inflationary environment will probably give rise to an increase of cost in general of operating businesses. And the question that we want to resolve today is, okay, how does that inflationary environment impact transfer pricing, if there is any impact? And then what can companies do about it? We have and hopefully we can give a few tips on this subject, and even just some food for thought associated on how transfer pricing can be impacted in the context of inflation, which seems that is here to stay. Before we get into the topic, this is just a general disclaimer that this presentation is just for guidance and discussion purposes only, and doesn't constitute professional advice and may not represent the views of Transfer Pricing Solutions Asia in the context of professional advice. Let us do a quick introduction for those who are new to our webinar. So we are a consulting firm that specializes in providing transfer pricing advisory services to multinational groups in Asia. We pride ourselves from being practical, proactive, and cost-effective in a world whereby a lot of the times the transfer pricing knowledge is concentrated in the top-tier firms. For us, we have been a pioneer in specializing in the area of transfer pricing outside of top-tier firms, even though we are all come from top-tier firms. We have three entities: our Transfer Pricing Solutions Australia office, Transfer Pricing Solutions Asia, based in Singapore, and Transfer Pricing Solution Malaysia. From the three offices, we advise multinational companies in Asia in different aspects of transfer pricing and also international tax associated with transfer pricing. We also enjoy, as you know, we do these webinars, which is a way of educating the region on transfer pricing, and equally we also contribute to industry journals, and we pride ourselves of being recognized with several awards as well in the region. So for those who don't know us, let me introduce first Hon Chuan Tan, who is our director and technical lead of Malaysia with 10 years of experience plus in transfer pricing and a lot of background in developing and pioneering setup of transfer pricing practices in Malaysia before joining us. We're lucky enough to have him now for 5 years plus with us, and obviously with vast experience in transfer pricing planning, risk management of transfer pricing aspects, documentation, country by country reporting, tax effective supply chain management in the Asia Pacific region across a broad range of industries. My name is Adriana Calderon. As you can see, I'm wearing the same jacket from the photo. Funny enough, I didn't plan that. I'm the director and technical lead for Asia, co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience in transfer pricing advisory, and also before that in international tax and general tax, working before with Big Four and mid-tier firms in different regions, but over the past 15 years, working in the Asia Pacific region and specifically on transfer pricing. And also have come across various industries and wide range of projects. So between Hongchuan and me, we probably have come across any type of transaction that a multinational group has ever entered into. So with that, let me just start with our agenda for today. So first, we're going to be talking about, not for long, but just a brief overview on what inflation is. Then we will be talking about what is the impact of transfer pricing in the context of the most common transactions that we come across and the most common business models. Then we will talk about what are the key strategies and takeaways. So with that, maybe I pass it on to you, Hongchuan, on the overview of inflation or what it means.
Thanks, Adriana. Welcome, guys. I think it's a good topic to look into, especially in our era. And it's good to then relook at what has happened, during the previous inflation phase. That was during the financial crisis, right? And first we need to look at what is inflation. It's actually I'm not sure whether you can skip to the next slide. Yep. So inflation is actually a very real phenomenon, and for those that have experienced it before, 08, 09, that is what we are experiencing again. And it is rampant globally, and I'm sure we would have felt the effect of inflation by now, right? Because inflation is generally a rate of increase. Price of goods and services increased over time, right? When it started increasing, we may not feel the effect, and when it has increased to a certain extent, that would have created a lot of issues and impact on our economic environment, right? And what caused inflation? It has been, for us, this situation has been caused by various external factors. These includes, you have your COVID, post-COVID, and then due to COVID, you have your global supply chain issues that are impacted. Then we also have the Ukraine war, ongoing Russian invasion of the Ukraine, which has really impacted on the global environment, right? So these are some of the factors that have affected and caused inflation. Now, what's happening in Asia is that before the inflation, interest rates were, they're very low, because during COVID, economy has went down. And for the government to actually boost the economy, they have actually decreased the interest rate, thereby boosting spending by lowering the borrowing costs. So this incentivized spending across the board, then boosting the economy, creating a higher demand. And you may have now a high demand, low supply scenario, right? Coupled with the supply chain effect. And when inflation kicks in, right, you have higher prices, then what the government will do again, which is a shift in the monetary policy by way of increasing the interest rates. Now, this will slow down the spending, right? So when interest rates are increased, then the cost of borrowing for commercial banks will also increase. Then when that increase, the interest rate will then pass on to consumers. In this case, then businesses and consumers will see high interest rate on not just borrowing, but also saving, which means that borrowing becomes very expensive. As a result, then you will see generally spending decreases and then slowing down economic growth. So that's the objective of the central banks across the board, where they're trying to slow down the economy. Hence, if less cash is actually spent in the economy, then the money supply will tighten and demands for goods will drop, right? So that is under assumption that they're creating a lower demand. Then when you have lower demand, then most likely your prices will decrease, right, to boost the economy and to get spending more. So the price will then decrease in accordance with the demand, then making things cheaper and then lowering. Objective is to lower the inflation rate, right? But for now, we are seeing the effect of inflation. Government are increasing their interest rates, trying to curb inflation. Then as of now, we still have to deal with the higher cost of living until the effects come on down. So you have lower inflation. And so that's in essence inflation and the impact on inflation. And then we're looking at inflation in Asia, right? On this slide, you can see that it hovers around 4.4 in 2022. 2023 is about 4.2. I mean, the outlook is that it will go down. So obviously that's objective, but we never know, which is moving closer to the pre-pandemic averages. Having said that, when you look at this chart, right, it can be deceiving because it's more or less an average of all the countries within Asia. So when you actually then look into detail what are the countries within Asia, right? So I'm starting from a lower one, which is the East Asia, which consists mostly China and Korea. Their inflation rate hovers around 2.3. Korea is about 5, but China is about 2. Hong Kong is about 1.9 in 2022. And then when you look at South Asia, which is India side, India region will be around 8.2. And India is actually lower at 6, but the increased inflation rate was actually due to the increased inflation in Sri Lanka. I'm sure you guys know the news on Sri Lanka where the inflation went up really high, and there was a lot of commotion that's happening in Sri Lanka. And Sri Lanka's inflation rate in 2022 was 46%, right? It has come down in 2023, about 23%, but that has increased the inflation rate. And then lastly, Southeast Asia, we have around 5%. In Malaysia is about 3.4 in 2022. Singapore was 6.1, which is actually rather high. Now, if you look at this scenario, right, that's where transfer pricing comes in. With varied inflation, you have varied cost prices. Then MNEs will need to look at, reassess their supply chain and looking at inflation rate that's happening within different countries, and then possibly restructure based on the inflation rate and to sort of lessen the blow caused by inflation, right? So these are things that is happening, and MNEs are actually looking closely to see how, in a organization point of view, how they could curb inflation internally, as opposed to having external factors that are actually impacting causing the inflation, so to speak.
That's a really good point, because I guess that's the benefit in a way of being a multinational group, right? And so that's a really, really good point. So let's talk about now impact on transfer pricing. So how do you see and which aspects of transfer pricing can be impacted with this?
Now, in terms of transfer pricing, obviously we have actually sort of characterized it into maybe 5 broad categories, those that are being impacted. First one will be intercompany loans. We have intragroup services, distributors, manufacturers, the first 4. And then we'll look at how it impacts entrepreneurs in an inflationary environment. So to see how entrepreneurs, holding companies, would have been impacted by inflation. Okay, all right.
So let's start with intercompany loans. Please go ahead.
Yes. So I guess as you know, intercompany loans is actually one of the main impacted transactions. Would when we look at increased interest rates, then loans will 100% be affected. And then for us, for transparency purposes, then we will need to reassess the impact of the interest rate by looking at terms and conditions of the contracts. I think over the course of our seminars, we have been emphasizing on the importance of contracts, especially now in when you have intercompany loans between entities. You will need to then relook at your contracts, right? What are the clauses within the contracts that that has that could determine the course of action that you may take, right? Whether you have repayment clauses that may allow you to renegotiate your contracts or intercompany loans to make sure that it can be realigned to curb inflation or the increased interest rates, and whether there are any availability of covenants. And by looking at the interest rate policy within the contract, you can then see whether it's variable or fixed interest rate. You have your base rate, and then whether you have using a variable or fixed interest rate policy to decide how best you can maneuver to then reach a favorable position for both entities within the group. So when we talk about contracts, we really need to make sure that before we formalize the contract, we have all these clauses in place. That's where the importance of contract comes in, right? You have clauses that you may be able to repay for early repayment, for example. Then that could then allow for another course of action to actually repay, then have a new contract available for the new interest rate to come in, right? So there are a lot of factors that could come in place when you have a good and formalized contract. And then the next important consideration, which is I think a rather important rule that we need to look at, which is the interest deduction limitation, coupled with your TINCAP rules and also the earnings stripping rules in Malaysia, for example. So you will really need to then reassess these rules based on the respective jurisdiction, because TINCAP rules and or earnings stripping rules can be quite different depending on the jurisdictions. And obviously the main mechanic is based on the debt equity ratio to determine the limit that you have for the interest deduction, right? So if you have now that when cost of debt actually goes up, then but the limitation stays the same, then by right you would have then an extra interest deduction, which may lead to a denial of interest deduction if there are no intervention by the government to actually go through the interest rate increase, then actually change the rules, change the ratio on the TINCAP rules so that it aligns with the current inflationary environment. So for now, we have yet to see, well, we have a few drafts in Australia, but we have yet to see, for example, in Malaysia on earnings stripping rules, they don't have any indication to actually change any of the rules or any of the indicator or the threshold being met, or the limit that you are allowed for interest deduction. So with that in mind, then with the interest rate increase, then you really need to then reassess by looking at the TINCAP rules to see whether you still stay afloat within or below the ratio. If it has increased or it has gone overboard but over the ratio, then you really need to make a decision as to whether to actually increase your equity or decrease your debt, right? So that's where you really need to look at the TINCAP rules and make sure that you don't fall outside the limitation, right? So that's one of the important parts that you need to look at to make sure that you don't have any leakages. And lastly, if you look at safe harbor rates, taxpayers can actually fall back to safe harbor rates depending on the relevant jurisdictions. So Singapore would have their indicative margins that you can look at to follow the safe harbor rates, and Australia do have their safe harbor rates. Malaysia unfortunately does not have any safe harbor rates in place for now, and it's a good avenue to relook at your intercompany loans and make sure that if, let's say, your contracts, the interest rate within your contracts would be may have gone out of date, and that it would be prudent to actually relook at your safe harbor rates as sort of a guideline, because government across the board, they will actually provide you with the safe harbor rates for each income year, so that will be a guideline for you to actually relook at your contracts to make sure that whether you're within the rate or not. So these are the few things that you need to reassess, and I think it's good to actually look at an example to see what's the impact of intercompany loans when inflation comes in. So in this
Okay.
example, yeah.
No, you go.
Okay. Yeah. So basically, in this example, when you look at the description, company A is the manufacturing and distribution of business semiconductors. They provide a loan to a financing entity, and then financing entity on lend this loan to company C at a base rate plus 2% variable interest rate for amount of 50 million in 2020 for 6 years. Now, as you know, in 2020, the interest rate is actually rather low, right? So when you have a low interest rate, that is where you have the contract in place. Then you formalize contract with all the clauses. Then come 2022 or 2023, where inflation kicks in, central bank increases the interest rate, commercial bank will increase the interest rates. Hence, in this environment, the issue is, how do we then negotiate the loan terms? We are talking about transfer pricing with intercompany entities. So we are looking at country B in the low tax jurisdiction, country C in the high tax. When interest rates kicks in, again, we will need to fall back to your contract, right? So when I look at a contract, we will need to look at what are the clauses within the contract that you can relook at to see what course of action can the group take based on the contract. When you have repayment, for example, then what are the clauses of the repayment? Does the contract allow early repayment? Does the contract allow any renegotiation due to certain circumstances that have arisen, especially in terms of like whether any economic changes, for example, inflation rate? So if that is available, then entities will can look at the contracts and then renegotiate based on the current environment. What are the interest rates that are available in 2022 and 2023, right? So when we look at the base rate and the variable interest rate, the variable interest rate will inevitably go up, and then that will create an impact on, when you look at the impact on the high tax jurisdiction, by looking at the thin cap rules or the earnings stripping rules, and to see whether the increase of interest rates would have impacted the threshold that they are going to meet. When they are going to when the ratio has gone over, then that will lead to a leakage of interest deduction, right? So there's a limit of interest deduction, which means that you need to do an impact analysis and see what is the impact from a 2% variable interest rate to now a 4 to 5%, depending on the jurisdiction, interest rate, to see what are the overflow that you're looking at, and then decision will need to be made to make sure that they are within the threshold, again, within a ratio of the thin cap rules, so that you are not denying any of your interest rates, so to speak. So it's very important to actually relook at the contracts that you have, what are the clauses that you have, and then looking at the relevant jurisdictions that you are in, and then the relevant rules that are being applied in the borrowing entity, right? So it's good to then relook at the whole intercompany loans arrangement and make the necessary adjustments to ensure that you don't fall out of the thin cap rules.
Thank you, Honchun. I think this is very good. There is one more point which you were talking about, which is contracts, right? So if the contract allows so, you can renegotiate potentially. I guess the question is, what happens if my contract doesn't allow to renegotiate, and in more aggressive tax authorities or more aggressive tax countries where the provisions allow for a total disregard of a transaction, whether even if the contract doesn't allow to do so, whether the tax authority will take it so far to say, well, anyone in the same circumstances would have just seek different remedies to not be paying or not be getting a lower interest rate. I don't, that's just a side comment in the sense that I don't know the answer to that. I don't know if a tax authority will take it that far. The only reason I bring this point in here is because unfortunately the transfer pricing provisions in a lot of countries allowed for tax authorities to recharacterize or disregard transactions. So that's the scary part. So that bit that I don't know the answer, but it's just a side comment. But thank you very, very, very much. So let's continue with intragroup services.
Yeah, I guess, yeah, intragroup services, I think the main point is because service provider is actually one of the important segments, especially in the developing countries, in Southeast Asia especially, and they can be affected in transfer pricing. In theory, even in an inflationary environment, service providers should generally be least affected because it's based on your cost base plus a markup, right? Even when you have inflation in place, your cost base will follow the inflation cost, right? So the thing is, then you are earning the markup. So regardless of whether increased cost, as long as you earn a markup, you're still a profitable level, right? And obviously then on the other side, for service recipient, then you really look at the increase in the service fee that's being provided. And for service recipient with an increased service fee, how could the service recipient be able to mitigate the inflation risk, right? So, which is what's happening right now globally. There are a lot of ways to mitigate inflation risks by way of looking at reduction of costs, right? Cost-cutting measures is actually one of the main things that we see right now. And you can see global companies actually doing a cost-cutting by laying off employees. We're looking at their service arrangement to see are there any lower service costs that are available, right? This number two part is very important because in transfer pricing point of view, that you will need to then relook at what an independent party would be willing to pay in your current situation. So it then brings you to the attention where you have a service provider, a related party service provider in the group providing such service, and that would you then have to relook at lower cost service provider that may not be in line with the service fee that is being charged by the service provider, right? That's one of the main things that tax authorities will be looking at to see that, okay, your cost base has increased. Why has it increased, right? So you have a service provider providing service, inflation, cost base increase, then tax authorities will be looking at, will that be accurate, or will that be arm's length? Have you gone to another avenue to see whether there are any service providers available that are maybe providing lesser costs, right? Or is your service provider providing the correct or arm's length pricing, depending on whether a benchmarking has been performed? So these are some of the impacts that may arise. So, I mean, the next example will actually sort of showcase a very interesting scenario where we're looking at low cost countries versus high cost countries, and see how intra-group services can impact various jurisdictions.
Yeah, I guess just on that last point that you were putting there, maybe before we move to example, is like whatever the company does, whether it is that it decides that the service provider is going to not have the inflation cost, or whether the service recipient is going to take some level of inflation risk, that needs to be properly put in place, in the way in which the agreements will be drafted and the way in which the pricing will need to be recalculated. But if we go back to the example, right, this is an interesting situation that we're seeing now. So please go ahead.
Yeah. So yeah, it's a very interesting scenario when we see that, we have regional HQ generally considered a high cost country, high labor cost country, while Company C and Company D, Malaysia, Indonesia, lower cost country, where in the first example, the service provider will be the Malaysian and Indonesian company providing a service to regional HQ. And when you see in this scenario, during an inflation, right, service fee will increase, right? But when you look at the scenario here, the service fee increase is based on the low labor cost country, that the inflation may have increased, but at the same time, it may not have significantly impacted the operating expenses for the regional HQ, because regional HQ is actually situated in, for example, Singapore, in the developed countries, where the overall service fee in Singapore is actually much higher than a low cost country. So in that sense, the impact for a service recipient in a developed country may not be as high as the next example, where you have a different scenario where the service provider is actually a high cost service provider and providing service to a low cost country in Malaysia and Indonesia. When inflation kicks in, right, even before inflation kicks in, the Malaysian Indonesian entity may have already been sort of break even on the service fee, because it's from the high cost country. When inflation kicks in, the service fee would have increased a lot more, and then Company C and Company D operating expenses would have impacted a lot more, right? So in this scenario, the bottom line for Malaysia and Indonesia would have greatly affected by just an increase in a high cost service provider. Now, this is actually a very real scenario, because it is actually a combined scenario. So generally speaking, low cost service provider will be providing routine services to regional HQ, and generally regional HQ would be providing a management services or strategic management services back to Malaysia on the basis that they are actually governing the business operations of the low cost country, right? So then that begs the scenario as to then Malaysia would start raising queries as to whether this service is actually reasonable, or the service fee is actually reasonable, acceptable or not, right? So then in transfer pricing environment, then companies see on an independent level would be thinking whether companies C would require such service, or would such service be able to be found somewhere else, right? Will I need a lower service fee? So that will then create an independent view as to whether another independent service provider will be able to provide such service, right? It's like a pushback scenario. But then at the same time, we will then reassess whether such service or such activity exists, right? Whether there are local expertise that was previously provided by regional HQ that can be found in Malaysia, right? So generally speaking, such expertise may not exist, or may not have such local expertise in place. Hence, due to the previous arrangement, that they require such service from regional HQ, as opposed to high-cost country where it will not be impacted that much. So when we're looking at corporate and management services, this is where there's a drawback, and Malaysian companies will then need to relook at services provided and to see whether such services are actually required or not, because then the impact to actually lower cost country will be quite significant, and that you need to relook at your transfer pricing and relook at your contracts, and then relook at your terms and conditions, and to see whether there are any avenues to actually reduce at least the markup to a certain extent based on the benchmarking or not. So this will actually increase or raise triggers to the tax authorities to see whether your cost base that are being affected by the service fee, whether it is in line with the arm's length principle or not, right?
Yeah, I think one of the key, as it is, we're having a lot of pushbacks generally at subsidiary level because of this reason, like what's the basis for regional or ultimate head office pushing down cost? Is it reasonable? Is it commensurate with the benefit? Is the methodology correct? Is it shareholder cost really, and not subsidiary cost or corporate cost? So I think if there is a big impact on the value because of the cost of the service provider, and is unreasonable in the eyes of the service recipient, I think that is something that can create a lot of disputes with the tax authorities. As it is, services is a very highly disputed transaction in general, because of the fact that I think most tax authorities just don't like them. They don't like when companies have deductibility on service charges in general, especially the ones that are corporate and management, etc. Is seen as an attempt sometimes to strip profits out of subsidiaries. So I think this is an area that everyone has to pay attention, because I wouldn't be surprised if more disputes will come out of this type of scenarios, when the only solution within the group is to just increase the cost base because inflation is going up. So I think that's probably where we'll see what the tax authority attitude it is on. Just say, okay, well, fair enough, the service recipient would just have to bear the cost of the inflation, or maybe not. So that's remain to be seen, to be honest, but is a very important thing to consider. So let's look distribution and manufacturers. So what do we have in the context of distribution and manufacturing?
Yeah. For distributors, I feel for them, to be honest, because the tough part for distributors is that they're sort of wedged in the middle of a manufacturer and a and consumer, right? So when you have inflation, then you would have a pressure from both consumer as well as a manufacturer, because on the manufacturer side you will have increased pricing, so which means distributor will have increased cost of goods sold. And then obviously when you have increased cost of goods sold, then the in inflation point of view, the price level would have increased. So in the second context, it's more towards dollar terms and not necessarily in sales at all. So it's actually sales value, and it'd be good to have increased sales, of course. But then during an inflationary stage, you may have decreased sales, right? But then your sales value would have increased due to the price increase. And then based on the benchmark, then you would have a percentage that would have been fixed, right? Now, the thing about distributors is that then you face a drawback from consumers, right? Consumers are driven by pricing, and that you have increased pricing, generally you have reduced demand, or you would have a pressure from your key customers to have the pricing stays the same, which generally may not happen, obviously. But then you have to then renegotiate with your customers, and to see what's the appropriate pricing to reach a consensus, so that both would have a favorable outcome. Now, because when you look at distributors, first you look at how the distributors are characterized, right? You can go from a limited risks distributor to a full range distributor. And in a limited risk scenario, generally speaking, when they have less activities, they would most likely have margin, fixed margin to be earned through their activities. While when you have a full-fledged marketers, then really in a group point of view, in terms of transfer pricing, you need to relook at between manufacturers and distributors, right? Who is bearing the inflation cost, right? Who is ultimately bearing inflation cost? Depending on the arrangement, it can be the manufacturer that's bearing inflation cost that they do not pass on to the distributors, or distributors are actually bearing the full inflation cost and then hopefully then pass on to the consumers. Or there is a shared arrangements where both manufacturers and distributors are sharing and bearing the inflation costs to make sure that these are properly in line with the arm's length principle. Right. So in this scenario, really, you need to look at your overall supply chain and then reassess the risks that are being undertaken by both the manufacturers and distributors. Right. So on top of that, when you have distributors, full distributors, they are also having another layer of paying licenses, then that will create another layer of impact to see whether the royalty or licensing, which is generally based on a percentage of net sales, right? So when you have an inflation, your sales are sort of artificially increased, thereby your royalty or licensing rate will increase by that amount as well, right? So in that sense, you would then be also impacted by your licensing depending on your operating expenses level, and see whether there are any other fixed operating expenses, variable expenses that could then impact your overall net level, right? So it's very important to look at not just your gross margin level, but also your net level, where a lot of majority of the taxpayers will be looking at to see whether you are profitable on a net level basis. And then that is where you raise triggers when you are consistently making losses, then you raise the trigger to the tax authorities to then review your operations and see whether actually you are operating at arm's length basis or not, right?
Yeah, I guess that's where one wonder if we have to then, in an inflationary scenario, we kind of cannot be that cut, like that crystal clear entrepreneur and routine, and then routine with guaranteed profit, because if you do that, then you're going to be bearing a lot of losses at the entrepreneur level or under the whoever is the principal in the transaction. So that brings us to the manufacturers, which, similar to the distributors, they will also have some pressure associated with their manufacturing cost. So the question is whether at the time that the manufacturer forecasts and budgets for the future years, they do not capture the inflation. And when inflation comes, then the price that they have agreed with the related party distributor or the related supplier of raw materials doesn't factor the inflation situation for them. So obviously there is going to be some issues for the manufacturers around predicting that manufacturing cost in their budgets and the forecast, and then ultimately having to make the decision as to who is going to take the risk on the inflation, and comes back to what you were saying earlier, which is what type of manufacturer are you? If you are a manufacturer that is a contract manufacturer, then probably you will be in a better position to pass your increased cost to the buyer, because a contract manufacturer is more seen as a service recipient. In the contrary, if you're a full-fledged manufacturer and you're not sharing the profit, but you are an arrangement where you guarantee a profit for your distributors, then you will be very much totally exposed to inflationary risk and potentially having to bear all the costs associated with inflation. Which is why I come back to the third point, which is like, if you have a situation where you're working backwards from end customer price properly, and then sharing the margins between distributors and manufacturers, then it will be easier, because you're working backwards from end customer. So if the end customer margin is shrinking anyway, so everyone is going to bear equally the shrinking part of the of that margin on the product, or on the particular product. So then, unfortunately, in my experience, especially in Asia, is not very common to see how the price between manufacturers and distributors is decided by working backwards from end customer price and sharing accurately the price, the margins between manufacturer and distributor. So I think that that's going to lead to a lot of headaches in Asia, because there is not necessarily a lot of the times proper planning on this front. So maybe with that, let's look at the example. So we can pass into the last part. So we have a company A, which is a manufacturer in China, and we have a set of distributors in Southeast Asia, which is company B, which can be any distributor in any Southeast Asia country. And then we have an end customer. So I think we kind of already talked about this, in the sense that how to manage the inflation on production cost. So it comes back to what type of manufacturer is the entity or company A. If it's a manufacturer in China that is not a principal, it's just a contract manufacturer, it's very easy to pass on the inflation cost to the distributors in the related parties if it's a contract manufacturer. If it's not a contract manufacturer, then, as I was saying, the increase of cost will probably be to some extent passed on to company B, but not not completely. It could be like a share situation, depending on what type of arrangement it is. Or it could be a situation where if company A has agreed on a certain margin of products and that margin is not covering their contractual cost and they are not proactive enough to renegotiate their margins on products to distributors, then they will be facing fully the absorption of the inflationary cost. So I think particularly for those manufacturers who are full-fledged and to some extent entrepreneurs, they will really need to relook whether their margins are sufficient to absorb the inflationary cost or not. And I think it comes back to the point that I was saying earlier, that maybe that's where working from the margin to end customer makes more sense to iron out the inflation, or to even between or share between the companies in the group the cost of inflation. And then with the distributors' margins, it comes down to what Hongchuan said earlier, which is like, if my distributor has a guarantee margin, then I guess to some extent his business is not absorbing the inflationary cost, because what I'm saying really is that no matter what happens, that distributor has a guarantee margin of 2 or 1 or 3%. But on the contrary, is a full market risk taker, they will probably be more under pressure to meet their target revenues and getting their margins under the scenario whereby you could have a situation where basically the distributor has distribution. Can you give me 2 seconds, please? Okay. So when you have a situation, let me just go back to this. So when you have a situation where the distributor margin can be basically under pressure because the end customer will not be willing to buy at the price that the distributor is willing to sell, and then they will have to basically work on revenue targets mainly. And then if the price is going up and up, the question is whether that distributor will not be able to meet their revenue target and therefore the distributor margins. So coming back to what you were saying earlier, it comes down to the type of manufacturer and the type of distributor. If it's a routine distributor and a routine manufacturer, you will probably be in a situation where the principal is taking the inflation cost. If on the contrary is a routine, is a full risk taker, then you will be in a position to kind of share the inflation cost. But I think you need to act early to understand what is the degree of sharing that each of the companies are going to be subject to. That would be my main point on this. Do you have any other comments on here?
Yeah, I think that's the main goal, that when we look at manufacturing and distributor supply chain, that we really need to reassess the supply chain, look at your characterization to see the overall bottom line that the group is trying to achieve, and to make sure that, you know, at the end of the day, to make sure there are arm's length principle. So.
And then we have as a last point the entrepreneurs, which I think we kind of have covered, but it has also some challenges as well. So I think the first challenge is around cost sharing arrangements, where we have a share agreement to share cost on the contribution or creation of intangible property. So in those scenarios, I think probably it is advisable to start looking into the assumptions that were made in terms of future revenue, because with increasing cost and maybe revenue targets, depending on how business go, not being met, whether it makes sense to be sharing that cost in the same proportion that was initially agreed in any cost sharing agreement, and especially the variables around the assumptions on the cost values, and also the forecast revenue and the assumptions on the revenue that is going to be used as the basis for splitting that cost. And obviously, we will have to revise to reflect any changes in the macroeconomic conditions and those macroeconomic conditions can also have an impact on the value of the IP as well. I think maybe with an example, it would be also advisable to talk about this and maybe put it in perspective. But if we see this, and I guess that just one point before we go into example is that if there is an impact on cost sharing, on co-creation of IP, then probably the company will have to relook at the assumptions, relook at the financial models, and if needed, have amendments on the cost sharing agreement on the values that were used for the purpose of that share of cost for producing the IP. So if we see this, we have here a holding company located in Singapore, who is the legal owner of the IP, is an invoice center to all customers, has C-suites, R&D for Asia market, and product engineering. And then we have some subsidiaries in company B, C, and D, which is Malaysia, Indonesia, and Singapore, that perform business developing and marketing in each of their countries. And these companies are earning a markup on total cost for these business development and marketing. So I know this is a typical business model that people get very happy, not happy, but tend to think that the end outcome is very good from business and to some extent tax planning point of view. Because the end result will be that a lot of the revenue and in theory the profit will be absorbed by company A and the routine profit will be absorbed by company B, C, and D. But in a normal macroeconomic environment, maybe that's in theory the end result. The problem is that if you are having inflationary cost increase that's associated with inflation, what is going to happen is that the company A in Singapore is the one that is going to bear all the costs, all the increased costs associated with inflation, not only for themselves, but also for company B, for company C, and for company D. So the question is the revenue that I'm captured big enough and sufficient enough to bear all that increase of cost, or on the contrary, I'm going to have a situation where I'm giving profit to company B, C, and D and making my head office not even breaking even because it has to absorb all the cost of the group. So I think that's where usually these type of models are very useful and have been used traditionally a lot in transfer pricing. But I think when you factor in the fact that we're going to be, if we think that we're going to be under inflation for some years to come, then does it make sense to concentrate under one entity the absorption of increased cost of operations and on top of that debt that is also increasing? So I'm not too sure if this is a good way of managing that type of a scenario and inflationary environment. So with that, maybe let's talk a little bit to wrap up some of the key strategies. Anything you want to go first, or do I go first?
Yeah, I mean, yeah. So basically, I think we always have our key takeaways to the end, and to make sure that what you can take home after this seminar. I think I would put contracts first. I think contracts is very, very important to make sure that we need to make sure that it's formalized, and we need to review the contracts again to make sure that it is in line with the inflation. And then, obviously, then we will need to then review and update the benchmarking regularly to make sure that it's also the markup itself is in line with the inflation, right? Then we need to monitor intercompany transactions that we have gone through earlier, and for manufacturing, revise forecasts and budgets to make sure that also in line with inflation, and most importantly, keeping supporting documents in place, because now that we are in this environment, and also coupled with an increased tax authorities activities, it's crucial to make sure that we have gone through this all in place, to make sure that when they actually come in, you have all these justification and documents in place to support your justification.
I think it's even a bit like when we were dealing with COVID. Remember in COVID, we were facing some of increased cost associated with COVID situation. So I think some of those questions are going to equally come into place. Like, for example, okay, if there is an increase of cost and it's excessive and it's abnormal, but it's not going to be abnormal in the long run because it's going to keep happening year after year, then who within the multinational group has to bear that excessive cost? And I think it's the same question that we were asking during COVID, but with the difference that is most likely going to be a recurrent situation.
Yeah, and you can't use COVID as an excuse now.
Exactly. So in that respect, maybe it makes sense, even if we have the opportunity to feedback even to tax authorities, that maybe that there is worth coming up with some measures like they did during COVID on what's the treatment on the inflation cost. Exactly. Because it's a bit like COVID, it's just that it's going to last a little bit longer. So that's where probably there is merits to start looking at relooking at everything. So let's see if there are any questions in the Q&A. Are there any questions?
No questions. Everyone is affected by inflation, they know it.
All right. Well, if anyone wants to reach out to us, we have our details at the end. All we ask everyone is to please like and subscribe into our channel. We have a lot of webinars coming in the next 3 months. Managing transfer pricing in Malaysia, managing intragroup financing in Asia, and managing intragroup services in Malaysia. So here are our details, and you can reach us at any time.
Yeah.
All right. No problem.
All right.
Thank you.
Thanks.
Thank you.